Welcome, everybody. I'm pleased to be here today. I'm joined with some amazing panelists. I think you guys have heard already. We hope to give you a little bit of insight from an enterprise perspective, from an investor perspective, about AI adoption at the enterprise. We have on my left Dr. John, a scientist, and the brilliance behind some of the AI applications that are being built at BBVA. On my right, Sasha, thank you for the last minute ability to get here. We know others have had some challenges with the weather. Appreciate you. Sasha's representing Atomico, a more growth and early stage investor, both. And then on the far right, Simone. Simon's coming from Partech, based in Italy, but really the fund is really based in France. Today myself, Jay Reinemann. I'm one of the general partners at Propel. We're a venture fund focused on the intersection of technology and finance, based in San Francisco, early stage investor. And I'll be moderating, obviously. Part of the panel is really examining a study that was done by MIT just a couple months ago, and maybe we can get you guys a QR code or something to be able to look at it. But it really talked about there's been a lot of hype around AI, both from investors. There's been boardroom demand for it. There's lots of people that are focused on it. But unfortunately, the study found that only 5% of the AI projects that have been going on have had successful ROI at those enterprises. And we're here to talk about that. We're here to talk about why that's happening. We're here to talk about, from an investor perspective, what we're seeing in our portfolio companies, what's been successful. Maybe we'll touch on valuations and some of the rationale and craziness behind those. We're going to try to go deep, and we're going to try to do it fast. We'll see if we have time for questions from the audience. If someone's got a really, really burning question, you might want to shout really loud. Otherwise, we're going to probably cover the time in what we have. All right? You guys ready? First question, we wanted to spark the questions with a, I'm just going to laugh at my own jokes. Spark with just this first one, and it's really intended to be something for the investors on the side. Are we in an AI bubble? Is this the next .com? Who's going to be the pets.com of this, and who's going to be the Amazon? Who'd like to start?
Should I take it? Okay. Thank you, Jay. Well, of course, I don't have a crystal ball.
Wish you did.
But let's say there are multiple signals that we are probably going a little bit into an AI bubble, both on the public markets and on the private market side. The private market side, of course, we have a lot of hype, a lot of fear of missing out, a lot of venture capital investors that are deploying huge capital flows at very, very high valuations on a number of companies that haven't proven a lot of results yet. On the public market side, on the NVIDIA and the others, also their valuations are skyrocketing. And at the same time, more recently, there were some announcements made by, for example, OpenAI and NVIDIA, OpenAI and AMD, that are kind of a little bit worrying. Having said that, I don't think we are in a similar situation of the .com bubble. I was probably a bit too young back then, but my understanding is that back then there were not a lot of solid business models, and so VCs were actually throwing money to these companies that had really nothing behind. Here we have a lot of solid infrastructure building. Now, if I have to say who are the Amazons today, I would probably tend to say that Microsoft plus OpenAI, NVIDIA, Google, all the hyperscalers that are building the LLMs are here to stay, and because I fundamentally see AI be part of our life 10 years from now. There are some generative AI applications that have no defensible moat, this kind of AI agent, chatbots or sales automation tools that can be easily replicated, where it's a little bit unclear whether they will survive or not. But as Jeff Bezos said last week, fundamentally, this entire trend should be good and create positive impact.
Yeah, I think I like, Simon, how you split it into the public and private. And being on the private side, it's really painful for me to say that what is happening right now is, let's call it normal, because if there is a lot of potential, then the private markets just reflect that potential in the multiples. I think if we look just at the deal dynamics and the terms that people are underwriting, they're completely insane. But at the same time, we have never seen before a private company worth $500 billion, right? Whether that's realizable or not, that's a big question. But I do think that on the private side, at least there is some argument around, there is big potential. There are a number of first mover companies, or in some instances, second mover companies where that is the benefit. And therefore, you can still create a lot of value. On the public side, that's where my worry is, just because if you look at the fundamentals in terms of all of the indicators, how overvalued are all of the assets, including some of the more creative ways to structure deals like AMD and NVIDIA and others. I'm not an expert in those, but it, at least on the high level, sounds quite creative. I think from that perspective, that's where the biggest concern is, because as a private investor, what we want to see is a path to sustainable liquidity. And that liquidity will come from either someone acquiring these companies or companies going public. And some of those things, the discrepancy between the public markets and the private markets, that's where the biggest concern is for me.
And depending on how these companies go, what the private companies will be relying on is revenues. And John, what do you think? I mean, what is it going to be taking for an enterprise project to be real? What percentage? The MIT study said there's only 5%. What does it take for some of these to be real?
Pretty trendy question. The MIT study made a huge splash. 95% of the projects failing is not a good measure. We are nowhere that number in BBVA. We actually track this stuff.
Meaning higher.
Right.
Okay, thank you.
Better, yeah. So out of the whole portfolio of AI / machine learning projects, 50% of the projects have a direct attribution to money, in a sense, right? It doesn't mean that the other 50% are a failure. In some cases, that attribution is not possible for whatever reason, right? If you are building, an AML system, you don't get to see the benefits unless you get a fine or you don't get it, right? So that's why that measurement is not really precise. But I think the general sentiment of the MIT study that doing these things at the enterprise level is not easy is kind of true. And it's something that we must take into account when integrating these things into the bank.
Noted. I think we should all note that they're a very good customer. 50%. Staying with you, John, for just a minute. You've mentioned, we really haven't talked about AI governance, or we haven't really talked about the BBVA's transformation in general. And maybe you can reflect on there to understand why where there's right. These bottlenecks for most enterprises. What is it?
So the thing I find fascinating is that the general narrative around why it's so hard to put these things into production for companies, I think many people think that it's because the technology, meaning the models themselves, they are not smart enough, right? They're kind of stupid, they fail, and that's not our experience at all. I mean, generally speaking, we found that the reason is not because the model is not there yet, it's because integrating this thing into the banking system is not easy, right? Allowing data to be seen by the model, allowing the services of the bank to be reachable by the model is in many cases where things get stuck, right? Because they need to be secure, they need to be compliant. There's new things that weren't there before. And that's, from my point of view, the real bottleneck are not necessarily this idea, which is that the models are not smart enough yet. I think they are for many applications, maybe not for all of them, sure, but for many cases, we are there yet, frankly.
What are you guys seeing in your portfolio companies of what's being successful in deployment? Or not successful?
I think one of the things, maybe just to follow up on the point in terms of the adoption and the things that prevent, I think on the not successful is many of these applications, they have a lot of potential, but then there are a lot of hurdles that companies need to overcome. One is behavioral change. The second one is everyone is talking about AI, but real push to adopt AI varies across different companies. And the third one is it's actually stunning how unpredictable those models are still on some instances, for instance, cybersecurity, right? If you introduce a new system into a bank, then you need to ensure that there will be no bad surprises. And I think from that perspective, when we see our portfolio companies, especially the ones that work within regulated sectors, think financial services, healthcare, and so on, there is a quite high threshold for what you need to go through before things get into production. And when they get into production, the success really varies depending on where in the stack you look. Coding applications are probably the ones that get adopted very quickly. On the other hand, the things that require heavy integration with your data systems, a lot of compliance, a lot of security audits, not as much. But the biggest things where we have seen adoption is where the systems are somewhat independent. So for instance, we're an investor in a company called DeepL that provides, it's a pretty sizable company. They provide machine translation powered with Gen AI and so on. With those, you don't need to have heavy integration. You can embed it into your workflow, and on day one, you already have something. On the far other hand, we have things like a company called Wakera that got recently acquired, where it's a cybersecurity solution. And before you get adopted, it's 6 months discussion. Even though there is buy-in on the board level, the C level, that something like this has to be in production before they adopt anything Gen AI related. But still, you have 15 different people that needs to be involved. Everyone is excited, but the things are moving much slower.
Cool. Listen, on our side, we have been pushing our portfolio companies to test and implement, AI solutions on different processes. The first evidence that we saw of what is working well is, for example, everything related to customer support, meaning kind of relatively low value-add activities, content creation, as Sasha said, coding, with all the caveats, and you really need to pay attention about all the security implications and the hallucinations that you might have. But tools like Cursor or even Claude are really powerful, to create a first MVP and then start from there. What we really saw is that some companies that can really interact among the different teams super fast is they have been able to create new product, new generative AI application that are having a lot of interest on the market, and that somehow can lower a little bit the CAC thanks to this interest. And this is super powerful. But this is something that has been done only by the kind of AI native companies, while those that are already at 80, 100 million ARR, they are already behaving a little bit more like an enterprise. So they have more processes. They are a bit slower in implementing this kind of tools.
John, Sasha, Simon, you must have some companies that, and yourselves, that are reliant on Anthropic, OpenAI.
Yep.
You've come to rely on them, or your portfolio companies have come to rely on them. What happens if they triple their prices? And not just for BBVA, but and there's other banks that are using them. What happens to entire industries if they triple the cost of their services?
Well, I think it's quite unlikely. The trend we've seen is the opposite in terms of, the APIs and the services becoming cheaper drastically cheaper, not just a little bit, but by 100%, 1,000% cheaper than a year ago. I mean, for sure, we've had to adjust. But again, the gap that you see now between frontier lab models such as Anthropic and OpenAI and the open source movement is not that big, right? So in the event of them tripling prices, we would switch. And that's one of the reasons why
You have the ability to
I
switch.
think, yes, I don't think that's going to happen. That's not the race they are pushing for. They really want to get as smart, as fast as possible. And I'm not really worried about them tripling our prices. And if they do, well, I mean, there are options, frankly.
Yeah, I think we'll come back to why you guys have options in a little bit, hopefully.
Okay.
Do you guys see any risk in your portfolio companies?
I'm a big proponent of open source. If you track what happened in the last 20, 25 years in the internet infrastructure, that exactly is the trend, where you have one provider of a technology, think of a database, think of any data processing piping and so on, and there is always an open source alternative, and there will always be providers that take that open source, make it managed by them, and they provide you the same experience. The other interesting angle is, I think the gap between OpenAI just on the capabilities of the model and the second best model is not going to be as huge as it was 3 years ago, 2 years ago. And therefore, I would expect there to be quite a strong competition, preventing them from just putting extortionate costs and prices. And I do believe that we already see that what they are trying to do is capture the land, right? Do the land grab. So from that perspective, maybe in the long run, it will be the case, but also there is an argument that LLMs, whatever the name is for the Gen AI models of the future, are going to be almost a utility that is going to be available to people in enterprises in different shapes and forms. So not something that we're concerned, but definitely something that we stress test when we underwrite investments.
Yeah.
Yeah, maybe I would just add, I agree with everything here. I would just add that you just need to pay attention that your tech team is actually not going all in with only one model.
Sure.
That in some cases might occur because otherwise you are just doing a massive vendor lock-in, and therefore you are then tied hands and feet to one LLM, and then switching from one day to another might be a bit more complicated than if you are orchestrating among different models since the very beginning.
Sure. Yeah, but I would argue that switching models is easier than switching cloud provider, for example. So, but you're good point. I mean, we have our hedges to avoid that kind of situation for sure. Yeah.
Maybe some of the most expensive or highly valued utilities in our history.
Oh, it depends how you view the overall market, right? There are numbers as large as tens of trillions of dollars that is going to be created, and then everything else kind of in that light sounds not expensive.
Yeah. Maybe back to you, John. Let's talk about RAG.
Okay.
What is it? What are you guys doing?
So RAG, this concept of retrieval augmented generation, which is
Say that again.
essentially retrieval augmented generation. It's essentially this idea of getting your data you have in the company, and putting in a way so that it is reachable by the model. So the model can answer questions only using your own specific domain, right? Instead of answering with whatever data has been used to train itself, it uses your data, BBVA data, right? And I mean, RAG is a great technology. We use it a lot. Many of these systems in production today use RAG. I think the interesting thing is that it points out to this idea of having good ideas that are not so good in the long term. And what I mean is that a lot of banks decided to go the route of, what I'm going to do is take all the bank's data, put it into a corporate RAG, and then make all the models access this domain data, right? And talking to some of my colleagues in the banks, the field is moving so fast, right? That this, system built internally gets, it's not updated, it's not state of the art pretty soon, in a sense, which means that it cannot compete what the market is offering in terms of solutions to make the model see your data, right? And that's fascinating, right? Because it's, again, this concept that BBVA follow very much, which is the path of least regrettability, right? What should you do now that you won't regret in 6 months? Which is extremely difficult given the
Fast-moving
crazy
waters.
pace of the advancement, right? So again, talking to some of my colleagues, they build huge systems, they put the data, and that's not competitive compared to some of the solutions that we have today. Many reasons, right? And again, this idea of making decisions that you won't regret 6 months from now is a big part of the strategy today for us. And that's something we spend a lot of time thinking, where do we wet and where we don't.
Hey, maybe something we haven't really discussed ahead of time was if you had a recommendation for startups in the audience in how to work with a big enterprise.
One of the things that I always mention is to avoid the word platform. So I hear a lot of companies, and they always bring this idea of this is the whole thing, right? This is the platform to build agents. And given what I just told you about regrettability, it's extremely hard for me to believe that a solution now is going to fulfill all these needs 6 months from now. So I would shy away from trying to present the whole package, which I get it, right? 3 years from now, it was neat. Companies, banks like us wanted this concept. But nowadays, I think it's counterproductive because it makes us doubt that we will be going with you again 6 months from now, given the pace of the technology. So I think it's more intelligent, that's my opinion at least, to focus on narrow angles and at least try to avoid that concept of platform. That's one insight for what it's worth.
Perfect.
I think we should take the blame for them always pitching platforms because that's what early stage
I know.
investors want to hear.
I know.
Okay, let's switch it up a little bit. Maybe it comes back to us to be blamed a little bit here because there's a lot of companies out there that really don't have much of a moat. I should say startups that don't have much of a moat. They're being valued at 50x their ARR. I mean, what are you guys advising, or what are you looking for a moat? Is it distribution, the data? Are they embedded deeper in the operations?
I think for us, the multiples are multiples, right? The multiples is just the clearing mechanism how companies get funding. And therefore, if someone is willing to pay 50x, it doesn't mean that we'll be able or we will be willing to pay 50x. And sometimes, it can be the opposite. And therefore, I think, we deliberately take a very cautious approach to how we think about, which companies deserve a premium versus the ones where we might not even be interested to participate in kind of in the bidding war, so to say.
There's nothing about FOMO.
Well, FOMO is real, right? That's kind of the bread and butter of early stage investing. But for us, if we're excited about the company, then price is a secondary consideration. If we're not excited, then we can always use excuse that price is too high. I think for us, from the moat perspective, and for me personally, I don't really like moats because if you look at all other industries, the number of cases where you have a moat is actually very limited. Think of like network effects or unfair advantages from the unit economics perspective. For other companies, like even as complex as like building a database, like unless you're an open source database and you have a community, there is no moat. Like complexity can be solved with enough people and capital. So for us, what it gets to is two things. One is if it's an application, then it becomes a question of distribution and how can you be ahead of others when it comes to distribution. If it's more in the infrastructure middleware, then it's about talent. And it's probably one of those rare moments where talent becomes the moat, because if you want to solve some of the most challenging problems, you want to have the best people. And by sheer numbers, there are not that many people that are best. So from that perspective, we have seen that the companies that have ability to suck out the talent are the ones that build the best models, that the ones that build the best approach to solving the problems and so on. But if we project in the next 5 to 10 years, that question almost becomes like, what is the moat, becomes useless, because suddenly DeepSeek released their model a year ago, and everyone who was asking where is the moat, asking themselves a different question, which is, well, what if open source domain has something like that, which is obviously stretches your imagination and forces you to think not necessarily about the long-term horizons, which is the way the industry for early stage investing has operated, but more like from the business building perspective, where is the unfair advantage?
Yeah, and speaking of talent, I mean, I think that talent right now, there's been a bit of inflation. So the talent is extremely expensive, the ones that know what they're doing.
Yeah.
Listen, on our side, and maybe just focusing on the application side, I think that access to high quality data for training of the agent is super important, and how you do that also by building super deep integrations with the existing systems of the companies, of your clients. If you manage to go really deep into the processes and building super strong and deep integrations, basically this is a little bit already a kind of mode, because unplugging those integrations and rebuild everything from scratch can be painful and time consuming. So yeah.
Two last questions. We have 3 minutes left. One for you and then one for you guys. John, because I think there's a bunch of investors in the room, as well as founders. So thinking about what to invest in as an investor or a founder, or where to spend your time as a founder, what's the most underhyped area that you would be a customer of?
I can think of two things. The first one is the fact that given the advent of GenAI, a lot of the efforts on traditional machine learning models have sort of died down, or I don't think to receive that much investment, and the value there is still huge. I was just reading a couple days ago a report where they were comparing the diagnostics, how well the diagnostics were comparing doctors, specialists reading X-rays, and LLMs, right? And obviously the doctors were very much better than the LLMs. But the point is that you would never really use an LLM for this particular problem. You have nowadays models trying to diagnose diseases from an X-ray using traditional machine learning, which is way better than doctors, right? And that's, again, the point that many, many applications don't require GenAI to be successful, and I think that's a point where we might be underinvested as a market. Okay. That's one. The second one is adoption of this technology by employees, meaning that I still have the feeling that many companies, not BBVA, but many companies don't really understand the impact for their employees to be using ChatGPT or whatever. I think that the value there is massive. Because measuring productivity is not evident, many companies shy away from, betting on this, and really is incredible the amount of things employees can do with a little bit of creativity and access to these tools.
Give it to them. Okay, 50 seconds, guys. You got to do this quickly. What's the most unpopular opinion or prediction you'd have for next year? You got 15 seconds.
Difficult. Difficult to say for sure. There might be. Today is still unpopular, but there might be a little bit of slowdown in this deployment of capital, and wait and see mode. Like let's see. I'm expecting a little bit of a small correction, not massive, but a small correction.
Okay. Sasha, the last 15 seconds is yours.
One popular view that I've heard is that the only way one can justify the valuations and the public markets and so on is the impact of AGI, or artificial general intelligence, on the society and GDP and so on. And I think my unpopular view is that even in 2026, we'll still be discussing what the heck AGI is. And I think it will take quite a few years for us to all even arrive at the consensus of the definition rather than even seeing the AGI making an impact.
Amazing. All right, that's a wrap. Hey, let me thank you guys, and also the audience. I'd love to thank the panelists for the insights that you guys were able to provide today. Appreciate you guys being here.
Thank you for having me.
Thank you.